The latest inflation report out today came in right where economists expected, 2.4% year over year, still above the Federal Reserve's 2% target, but it's lower than we were a year ago, and wage growth has generally outpaced inflation over the past year. But when you dig into the CPI report, energy may be the real hinge point. Oil prices have been climbing again, and with geopolitical tensions involving Iran, markets are watching closely. Joining me now is Dale Smothers, President and CEO of RDS Wealth Management. Dale, good to see you. So it's important to note here in today's CPI report, this inflation data mostly reflects prices from before the war in Iran escalated. And you say an important part of this story is energy. Why is oil such a critical hinge point for where inflation goes next?
Certainly. All eyes, Alicia, will be on the Strait of Hormuz here over the next couple of weeks. And what happens there will determine where inflation goes, at least from our standpoint. You know, the American consumer right now has seen inflation relatively stable since 2023, 2024. We started to see this stabilize from that point. We saw some really high inflationary numbers in 2022, and this affordability crisis has come full circle now, front and center in front of the Trump administration. One of the ways that they have been able to keep inflation fairly stable is because of low energy prices. If we see energy prices creep higher, stability of inflation could be in jeopardy.
Yeah, and the inflation report, the CPI inflation report today doesn't yet reflect the impacts of the Iran war, like we said. So if oil prices stay elevated, how much could that push up everyday costs for Americans? I mean, here we've already seen $5 a gallon for gas here in California again. What about transportation? You know, I was just looking online at airfare to book spring break. Those prices are shocking. I might have to tell the boys we're staying home this year.
Staying home, yeah. And it doesn't matter if you drive or you fly, it still is impacting gas prices. The jet fuel or the fuel to fuel your own personal vehicle will increase, especially if we see oil prices above $80 a barrel. You know, the country runs pretty smooth on $60, $70 a barrel oil. When we get to 80, it starts to shake a little bit. At 100, things are starting to become a little bit unstable, even more so than we're feeling right now. And at $120 a barrel, things just get almost completely unaffordable for everything that flows from the transportation of goods across this country. I mean, it doesn't matter if it comes to you by train, plane, or automobile, you're going to feel that because of the price of oil. So the oil price is something we're paying a lot of attention to here. And to be real frank with you, I think that if oil stays above $80 a gallon, where you're going to feel that immediately is the consumer staples. The things that we consume on a daily basis that will likely become more expensive to get on the shelves of the grocery store. It's kind of ironic to think about oil pricing affecting the price of lettuce. But that type of connection is something we all have felt in the past, and we will feel that again in the future if we don't get oil under control.
Yeah, this won't be good before the midterms if it stays this way or even goes up. We've also seen mortgage rates jump back up to around 6% in recent days after the Iran strikes. How does this a geopolitical conflict thousands of miles away end up affecting something like mortgage rates here in the U.S.?
The price of oil creates uncertainty. The uncertainty, ironically, is about inflation. And if inflation is the result of higher prices, then it makes it hard for the Fed to lower interest rates. And with potentially higher interest rates to combat inflation, you're seeing 10-year yields and even longer-term maturity yields rise. This uncertainty causes the flexibility, or the volatility rather, in that 10-year yield, which affects interest rates at home. This is all connected. It's all intertwined with one another. And what we've got to see is the Fed have a clear path forward of how they're going to handle their own monetary policy to be able to then impact interest rates. We've got a new Fed chair coming in May. It very easily could be Kevin Warsh, depending on some appointment confirmations. And what I expect is that the Fed will come forward with a more clear picture. But the data that they are receiving, Alicia, you've got a softening labor market and an uncertainty in inflation. It makes it tough for them to act either way. And again, that uncertainty
Mm-hmm.
only causes more volatility in the interest rates that matter for Americans, mortgage rates.
Well, we're hoping for a win. Dale Smothers, President and CEO of RDS Wealth Management. Thank you.
Always a pleasure, Alicia.
Likewise.